Real estate, 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 real estate. I know some people that came from none of them same people real estate rich. If you're thinking about getting into real estate, you should holler at Real Estate Rich. Real estate, real estate.
Peace family, it's Richard Gilbo again, owner of Pinstar LLC and Rich Properties and Holdings. And a lot of people know me as Real Estate Rich. And I just want to give you guys another real estate tip. So a lot of people don't really know what this is. I thought it was kind of common, but a lot of people don't really understand this. And it's called a few different things, but the one that I heard was kind of popular is called house hacking. So what this is a 4-unit apartment building. You can buy this 4-unit apartment building. One second. There we go. You can buy this 4-unit apartment building. If you don't already own a house, you can get an FHA loan, live in one of these units, and you can buy this with 3.5% down. So in my area, you can buy a 4-unit for $100,000. I don't know what that looks like for you. If you're in California, you know it's gonna be a lot higher. Florida, Mississippi, it might be the same price or cheaper. But in my area, you can buy a 4-unit for $100,000. So you have this 4-unit, you're living in 1 unit, and you're renting the other 3 out. In my area, you can rent out an apartment for about $750. I own easily for about $750. So unless you're in Section 8, then you can get more than that. But for easier numbers, we're gonna just use $750 for this scenario. So you're buying this property for $100,000. You're putting 3.5% down for an FHA loan because you're living in one of the units. It's now an owner-occupied residence. So 3.5% down of $100,000 is $3,500. So once you buy the property, you're gonna have to pay closing costs. So once you add the title company and they're transferring that title over to you, all of that work that they're doing, they're checking the title to make sure it's good. You're gonna have to pay them for all of that stuff that they do. And for round numbers, we're just gonna say $2,500. It'll vary depending on where you are. It could be less, it could be a lot less, it could be a lot more, depending on where you are and the title companies that you use. Because in every city, every title company is not gonna charge the same amount. So altogether, we're gonna say that you're paying $6,000 to move into this apartment building. You're the owner of this thing now. The bank still owns it, but you're paying the mortgage. But the beauty about this is you're living in 1 unit and you're renting 3 out. So your mortgage on this $100,000 payment might be between $500 to $700. So if you look at it, that's one of your units. So one of your units is paying your mortgage for you while you're living here for free. The other one, you're gonna have expenses, taxes, and insurance. And don't let this stuff, kind of scare you, because taxes is only one time a year. You're gonna make money off of this thing the whole year, and then one time a year you'll pay taxes. For $100,000, it shouldn't be that much, depending on where you're at. So insurance is not that high, depending on if you're in a flood zone or not. But all of this stuff is easily taken care of with your other unit, depending on the expenses. If your AC goes out or something like that, then you would have a little bit more money, but you're still making money off of this the whole year. So both of these units right here you might not get any money from them. You might get money from this one. This one is probably going to be chalked up to your mortgage, so we're gonna cross that one out. This one, just to be safe, we're gonna say that you're paying your taxes, your expenses, and your insurance with this one. So we're gonna cross that out too. All of your expenses are now covered. Besides your living expenses, your lights and water and things like that. But that could possibly be covered in this too, because every month you're not gonna have expenses, and depending on the amenities that you have on the property, you might not offer air conditioners or washer and dryer or a stove and things like that. So you won't have to replace those things if they go out. That might be for the tenant. So you'll have less expenses that way. So every month you're not going to be paying expenses, and some months you might actually get this full or close to this this full amount of rent for this tenant. But for round numbers, we're just going to say that you're only getting paid off of this tenant right here. You're living for free. Your mortgage is getting paid down, and your expenses are getting paid, and your taxes. You're still living for free, and you're putting $750 in your pocket. So some good things about that as well is it appreciates in value. If you know anything about real estate, you buy right. So you'll buy it right, meaning this property, you bought it for $100,000, but it's worth about 125 maybe. Easily you can buy a 4-unit for 125 out here, you know. So it's worth more than what you bought it for, and it's gonna go up in value. So you bought it less, it's worth 125, but you bought it for 100. So you already have equity in it, but it's also going up in value. It's also appreciating over time if you're buying right. And that appreciation means that it might be worth 125 today, but in a year from now it might be worth 130. In 10 years from now it might be worth 150 or 160 or 200 or 250. You know, you never know, depending on how the market goes. And in some cases it can depreciate, and that's another thing that's actually a benefit if your property depreciates in a way, because it'll be tax write-offs for you, because this is taxable income. So unless you're in a opportunity zone, there's a whole bunch of different details we can get into, but if your property, every year, even if your property appreciates, you still get to write off a certain amount of depreciation. Meaning, you're bringing in $750 a month on here. Let's just say, for whatever reason, you're making $5,000 a year off of this property that you're living in for free, by the way. Your property is going to go down in value, or is going to depreciate. Even though it's appreciated, it's not going down in value. You can actually write off a certain amount, because they're going to say that your property is going down in value, you know, on paperwork. It's kind of weird how it works, but that's how it works. So your property is going up, but you still get to write off a certain amount as depreciation for your property. So you're not paying $5,000 of taxes anymore. You know, you're not paying taxes on $5,000. You might be paying taxes on $2,000, which is a big difference. You know, I want to keep all my money in my pocket if I can. You know, so. But yeah, so you get equity because you bought it right. So it has $25,000 in equity already. Plus, it's going up in value over time, so it's appreciating. So that's another benefit of it. You're getting principal pay down, meaning these tenants are paying down your mortgage for you. You know, you're getting this property for free pretty much. You paid this down payment, but you're making that money back by living in it and getting that income from this property, from this tenant. And you get the cash flow. Every month, you know, after a little while, you'll start to see that you have a certain amount of money that you'll be able to account for. You know, every month you'll have $750 coming in. Some months you might have more than that. Some months you might have a little less than that. But you pretty much know you got a threshold, you know. Some months you'll know, hey, I know for sure I'm not getting less than $500 this month from this property that you're living in for free. But what's so good about this is once you start paying this mortgage down, after 13 months, after a year, whatever FHA's guidelines is at that time, you gotta buy another one. So now you don't have just one tenant paying you income anymore. Now you have now you got 7 tenants paying you income. 1, 2, 3, 4, 5, 6, 7. And it's the same thing for this property. We're gonna do the same process. This one's gonna be the same amount. You know, 100,000, same down payment, because you're moving from one unit into the next. But and this works because you don't have a personal house. If you have a, you know, personal house, whatever that is, if you have a personal house and you tell FHA, look, I want to buy an apartment and use it as and live in it, they're going to be like, I mean, they're going to think that you're crazy. Why would you leave from a house, a nice house, in order to move to an apartment? But if you have an apartment and you decide to move to another apartment, that's kind of logical, you know. But nobody will move from a house into an apartment, not the typical person. So if you don't already have this house, you can do this all day. You can do this 10, 15 times if you want. You know, so you start here. This is definitely a good way to get into real estate. You don't have all that cash up front. You know, if you have your personal house and this is a $100,000 property, you're paying about $20,000 in order to, just for the down payment, you're paying about 20% just to get this property. But if you don't already have a house, you can get in this for 3.5% down, plus your closing costs. You know, so it's definitely a beneficial way to get into real estate. And like I said, you got 7 tenants paying you now. Over a year, you was getting income on this property, and then You move into this next property and it's the same thing. You know, this one's paying on your mortgage. This one's paying your interest and taxes. This one's going in your pocket. But now you have this one paying your rent too, and this one paying your rent, and this one paying your rent. So now you got 3 tenants, 3 units paying your rent instead of 1. So you just doubled up. Now you go and do the same thing again, and now you got 5 tenants paying your rent. You know, and so it's definitely a good way to get into real estate. You get cash flow, equity, and those are just the tangible things. You know, just think about the intangible, the emotional effect that you get from it, knowing that you got some money coming in every month, regardless of if another COVID happens or something like that. You know, you're out of work. At least you know you got a little bit of money coming in from somewhere. Hopefully, if your tenants are able to, you know, to stay in there. But you know, it's definitely a good peace of mind. You got power. You own the rights above your house and the rights under your house. So you want to go and build on top of that, you can build on top of that. You know, if you want to go and do like those guys do on YouTube and build your underground house, you can do that too. That's all your property, you know. So feel free to give us a call anytime, 844-956-1448. And I didn't mention, but you can buy this with business credit. If you're able to be approved for a FHA loan, you're able to be approved for business credit. And we can get you up to $150,000 that you can use. You can purchase this property cash if you want. Just have all 4 of these tenants paying you, and just, you know, walk away. You don't have to live in one of these units. So if you have this house already and you want to get into this game, if you can be approved for FHA loan, you can definitely be approved for business credit. And we can get you up to $150,000 in business credit that you can pull cash out of. You'll probably pay less than you would if you were getting a FHA loan. You'll probably pay more for FHA than you would for business credit. You're only paying it back about 1% a month at 0% interest. So, you know, it's definitely beneficial to look into this. If you're looking to get into something like that, start researching the 4 units in your area, or 3 units, or 2 units. But the reason why we go with 4 units is because, just think about it. If you have one house like this one here and you got tenants in it, this is 100% of your income. As soon as these tenants leave, 100% of your income is gone. Let's say you're in this. Each one of these units is 25% of your income. So one person leave, you still have 75% of your income coming in if you're not living in this one unit. So just think about that for 100 units. If you have 10 people leave, that's still only 10% of your income. So it's kind of a numbers game. You know, you'll have bigger expenses, you'll have bigger fees and stuff like that, you know, but you have the peace of mind knowing that you're not tied to just this one tenant. If this one tenant decides that they have to go and move out of town, you're 100% out of income. So if this property is vacant for 2-3 months, you're paying all of this on that property for yourself instead of the tenants paying it. You know, so that's one way I look at it. That's one reason why I like apartments. And 4 units or less is considered residential real estate. If you go with commercial real estate, that's the area that I love the most. 5 units or better in apartments is considered commercial real estate. And with commercial, this property is worth $125 because it's residential. It's based on the comps in the area. So other 4 units are going to determine what this 4 unit is worth. With commercial, 5 units or better, it's not dependent on the comps as much. It's really dependent on the income that the property brings in. So a 5 unit bringing in this amount of money would be way higher than this $100,000 or $125,000. Probably be worth, you know, $300,000, something like that, just because of the income that it's bringing in. And I talked on a previous video about forcing appreciation into it. So you come in at a certain price, it's worth $300,000. Within 30, 60, 90 days or a year, it's worth $50,000, $100,000 more than that, just because you raise the rents or the property is just getting more income. You know, so there's a whole bunch of different avenues you can get into in real estate. And you can use business credit to get into this game. Just think about this. You know, you get $100,000, you can buy, you're paying $20,000 down to purchase this property. You can buy 2 or 3 of these at one time just by getting the first round of business credit. And that's not talking about when we go back to get you more money, because that's just the beginning level. Once you get this business credit and you start using it, we're going to bring you back bring you back to those same credit issuers or lenders who you used, and tell them to give you more income. You know, so you can go back and do this all over again. Those are revolving lines of credit, meaning they're there for you when you decide to use it. If you don't use it, you don't pay on it. It's not like a loan or anything. So, you know, definitely reach out to us, PennStarLLC.com, PennStarLLC.com, and I look forward to doing business with you, and I'll see you at the top.
They used to say I'm the crazy one, now they be watching me getting it. And they're right, I'm on, but don't want to get it alone. I'm trying to put somebody on.